Wow, guys, big things are happening in the oil complex this week. We've got tariffs going into effect, we've got trade negotiations going on. What does it all mean? What has crude price been doing? Is it finally set for a breakout? Let's find out. I'm Aaron of the Oil Balance. I've got 30 years of experience as a professional trader and analyst in the oil markets. And I've got some insights I want to share with you this week in oil. All right, let's get right to it. All right, here's some of the big headlines going on this week. As I mentioned, the tariffs are set to go into effect as of March 4th. For as far as the oil complex is concerned, Canadian oil is tariff 10%, Mexican oil is tariff 25%. China is also seeing a 10% tariff go into effect. Of course, they don't really send us oil or refined products or anything like that, but just on products that they send us in general. And that's actually causing a bit of a shockwave, it seems, in the Chinese financial markets. As I mentioned, we're also seeing peace negotiations going on between the US and Russia for a peace deal in the Ukraine. As I'm recording this now, Zelensky is actually meeting at the White House with President Trump, trying to put final signatures on everything. And so we'll see how this plays out. Now, a couple people have already been fairly vocal on this, and I think they're right. Tradehouse Trafigura thinks the U.S. will ease sanctions on Russian oil. And again, I think that's probably right. It sounds like Europe still wants to send troops to Ukraine, so perhaps there's a peace deal between the US and Russia concerning the Ukraine, but not necessarily between Europe and Russia. I mean, how's that going to price out? There's also been talk about too little risk premium going on. I think that's absolutely right. We're not exactly out of the woods just yet, but the market's trying to figure out how to price all this stuff in. In terms of actual oil flows, we've seen a couple interesting things in the headlines this week. Kurdish oil is set to flow again. So, again, that's sort of northern Iraq oil that flows through the Turkish pipeline to Ceyhan, and there it goes out to the world. That oil hasn't been flowing for 2 years or so now. So, that's the potential for maybe 200,000 barrels per day to flow. The Iraqi government, which again, it's as I mentioned, it's northern Iraq. The Iraqi government's technically in charge of that oil production. They keep pushing this headline saying, yes, these flows are imminent. They've reached an agreement with Turkey over the pipeline restrictions and pipeline payments. But now the Kurds themselves are saying, hold on, not so fast. So we're going to have to wait and see how this actually works out. What we are sure of, though, is that Trump canceled Chevron's license in Venezuela. Again, Chevron was importing about 240,000 barrels per day of heavy crude from Venezuela into the U.S. under their license. So, again, it's crude oil that Chevron is pulling out of the ground in Venezuela using their upgraders to bring it to a point where you can actually move it and refiners can consume it. So strictly speaking, I guess it's not Venezuelan crude coming from the state-owned oil company PDVSA. It's actually coming from Chevron. At any rate, Trump canceled the license that Chevron held to be able to import that Venezuelan crude, citing election nonsense going on in Venezuela. So again, these two sort of offset. If the Kurds were to flow oil again through Ceyhan, through the pipeline, they could probably mostly offset this loss of barrels from Venezuela, but we'll see. We'll see how that goes. Also in the news this week, on sort of the macro front, it looks like the signal that the Fed is looking at as far as inflation goes is not going the right direction. The core personal consumption expenditures rose 0.3% month on month, and that's up 2.6% year on year. So it seems like the Feds will not be softening rates anytime soon. They want to see inflation start to come down before they start cutting rates. And then just this morning, GDP Now model from the Atlanta Fed is calling for Q1 GDP to growth to fall 1.5%. Previously, it had been up like 2%, 2.3%. So a big change there. The other thing, as I mentioned before, China's financial markets seem to be getting a little bit beat up with these tariffs right around the corner as well. There's a couple headlines going around asking, questioning, are we seeing peak oil in China? It seems like their crude oil consumption, their crude oil imports in 2024 were down about 1% year on year versus 23. So that would be a really big deal. We look at Asia in general as being the place for growth, and China in particular as being, sort of the heavy hitter in the area. And if China's not growing, it's going to be tough to meet some of these demand growth assumptions that the market thinks are going on, or that the market's already priced in. So getting ahead of the tariffs, it's interesting for me to see this crude oil stocks in the Midwest. So this is Pad 2. Cushing is the delivery location of the WTI NYMEX contracts, as I've said before. So this basically sets the price, how low inventories are, how high inventories are at Cushing. Helps to go a long way to set the price of WTI. Cushing is just one location within Pad 2. There's a couple other smaller storage locations in the Midwest or in Pad 2. If we look at those, they're actually relatively low, pretty well below the 5-year average, and falling behind year ago inventory increases we saw at this time of year. However, Pad 2 crude runs, so the crude oil actually going into refineries to be turned into refined products, is actually going along at a pretty strong rate, especially versus year ago. I think we had an ice storm come in about this time last year, early February timeframe, and that really impacted the BP Whiting refinery. At any rate, we've seen some planned maintenance going on in Pad 2, but overall, the throughput of crude oil at Pad 2 refineries is actually pretty strong, which is leading to really high refined product stocks. So combining all this together, so this would be gasoline, jet fuel, diesel fuel, and residual fuel. We're slightly above the 5-year range for this time of year. And if nothing else happens, if the Canadian tariffs go into effect and they really don't have a huge impact, which is probably my base case, oil keeps on flowing. Everything else has to sort of adjust for that 10% tariff. We could be in trouble in Pad 2 in terms of margins, in terms of refining margins, right? Because you've got such high inventory, you've got low crude stocks, and you're still running at a really strong rate. It's conceivable the market needs to send the signal to the refiners in the area, hey, you need to calm down, knock it off a little bit, et cetera, et cetera. That being said, if we do get into the low probability situation of Canada deciding, hey, we're not going to send any crude to the US, and Pad 2 is the biggest consumer, the Midwest is the biggest consumer of Canadian crude by far, that's going to hurt these refiners really badly, especially when stocks are already on the crude side are already really low. There's no fantastic way, there's no good way to resupply heavy crude oil into Pad 2 in any meaningful way to offset missing Canadian barrels if it should come to that. So again, I think that's a pretty low probability, but it's not zero, so we need to at least acknowledge it. On the domestic demand front, we're actually seeing demand up 3.8% so far in the year when you combine basically these four together. A lot of what's driving that is the heat markets, if you will. So distillate can go in as a heating fuel, especially on the East Coast. Propane this time of year is also used as a heating fuel, and that seems to be where the growth is coming from. I think I mentioned before that last year the demand in distillate looked really poor this time of year, and so sort of year on year we're seeing huge swings just in the distillate demand itself on the weekly numbers at any rate. So another thing to sort of be aware of, if this is just the increase from cooler weather, from winter weather going on, and this is truly heat demand, that's pretty impressive. The other thing you have to keep in mind is with the way the tariffs are structured, it seems like Trump is trying to get foreign companies to come in and build factories and whatnot in the US and actually start producing things. There's a lot of diesel fuel needed to for the construction of any new brick and mortar complex, especially in manufacturing and heavy manufacturing and that sort of thing. So we're off to a good start already with distillate demand so far this year. If we do get a ton of growth in the second half of the year coming from construction projects, large construction projects, so we could really see some outsized impacts from distillate demand hit the market in the second half of the year. And stocks are not they're below the range right now, so they're still pretty tight. But heating season is over. If you take a look at your calendars, it'll be March tomorrow. By the time I'm recording this, that means we're into April futures in the futures market for ULSD or heating oil. The futures market is always forward looking given the name. And so, we're pretty much past heating season, is what I'm trying to get to. Yes, we could have another winter blast come through and whatnot, but again, it's not going to be as cold as it would have been, as that same storm would have been in January, February. And the market's already looking to gasoline season, which is what I'm trying to convey on this chart. Overall, gasoline stocks in the US are pretty high. In Pad 1, we're quite a bit above year ago levels, not quite at the high. Pad 1B is New York Harbor. That's the delivery area for the RBOB futures contract. So again, it's above year ago type levels and trending nicely with what we saw last year. Pad 3 is maybe a little bit tight, but there's a lot to work with in the Gulf Coast in terms of refineries available, and maybe they can do some fine tuning on yields. We'll see how that goes. And then Pad 2, just looking at the gasoline, as we sort of saw in the last chart, Pad 2 gasoline is right at the top of the 5-year range. And, not quite as high as the peak we saw last year just yet, but still doing pretty good for this time of year. Overall gasoline yields are tracking about with year ago type levels. But again, with the premium we're seeing in the distillate market so far, I'm not anticipating a huge yield switch just yet. We'd have to have something, some new information come in, either an unplanned outage that really impacts gasoline, or maybe just, better demand than what we think is coming into the market to get some sort of yield switch. So not really anticipating that just yet. But the market just seems complacent. If you look at where we are pricing versus the last couple years, so I took out, typically we look at a 5-year range or that sort of thing. Of course, 5 years ago was 2020, and then you had 2021. So a lot of wacky things going on with the COVID shutdowns and whatnot. So trying to strip those out a little bit. The problem with that is, of course, in 22, you had Russia invade Ukraine. And so that kind of swung prices back the other direction. But I wanted to sort of keep that in there as maybe an upside scenario, going back to what we previously said. If there are issues stemming from the tariffs, the oil tariffs that are going into place here in a couple of days, if there is peace plan brokered between the U.S. and Russia regarding the Ukraine, but not between Europe and the rest of Russia, if things still percolate there, there could be some more risk premium to be priced back into the market. Going back to that earlier comment, I believe it was Trafigura that sort of openly stated it, that there's not enough risk premium in the market at the moment, and I would certainly agree with that. And I've been saying that too to friends and people who will listen. So at any rate, you can see in all 4 of these categories, WTI crude oil at Cushing, Brent, spot prices in the North Sea. So this is the European crude oil contract, Gulf Coast conventional gasoline, and Gulf Coast ultra low sulfur diesel, ULSD. All 4 of these are trading below year ago type levels. Not exactly super cheap, but you can see how the risk premium has worked their way out of these markets. In terms of margins, again, just looking at the Gulf Coast and the East Coast, gasoline margins on CBOB versus WTI, they're trending upwards, kind of following last year's pattern, but again, not super strong at the moment. Gulf Coast ULSD or diesel fuel versus WTI has been pretty sideways. We had a lot more fun last year as the market moved around. This year, the price has been relatively flat and they could intersect here. Again, if nothing really comes of these tariffs in terms of market reaction, they just go into effect and the barrels keep flowing. We could see these continue to sort of grind lower again as the market turns its attention away from diesel and towards gasoline as we go into driving season. Hopefully, that'll give us some time though to rebuild inventories uh, into the second half of the year when demand could really kick up if we do start to build more infrastructure. Similar sort of thing here on the bottom two charts, New York Harbor gasoline versus Brent. So this is more representative of what the refiners are seeing on the U.S. East Coast. Pretty much tracking with year ago type levels now on both. So maybe higher end of the 5-year range for the diesel side, lower end of 5-year range for gasoline, but nothing too crazy going on. Again, if we do get some sort of issue with the oil tariffs regarding flows, these would all change pretty quickly. And then lastly, looking at the weekly chart, I like to look at the weekly chart as sort of a way to zoom out a little bit on what's going on. So just the April contract here, J is April in futures speak. The April contract is seeing quite a big sell-off. So back here at the top of this rally at the beginning of the year is when Trump came in and was talking about all these tariffs and what it would do. We had really low crude stocks at Cushing, which have since recovered a little bit back to the bottom of the 5-year range, but still, in my mind, an issue, still too low. But now we have peace talks going on with the Ukraine, as we've mentioned, and the markets come off quite a bit. We've also got a lot of planned maintenance going on around Cushing, which is what's letting those inventories build up. So that's taken a little bit of pressure off too. The spreads have not gone off, super strong. We were seeing spreads in excess of $1 per barrel backwardated. They went off, 18 cents for the March, April. Still backwardated, but probably $1 or so off the highs. On the other hand, just looking at this April contract, it seems there is some sort of support coming in here, sort of in the mid $68 region that the market's bouncing off of. So I think we probably do some bouncing around, but I think we're also sort of at an inflection point, meaning in the next couple of weeks as we go into April expiration, I think it should be interesting. We could see a breakout to the downside if the tariffs don't really amount to much. The barrels keep flowing. Everything's fine. Just it's a price movement, a price adjustment that has to compensate. We could see prices breaking lower, at least for a short amount of time. On the other hand, if we do get some support, if we continue bouncing off of this trend line support, we could see prices bounce back up into, sort of this mid 70 type area, which would probably be more appropriate for the springtime. Again, as I said, the market's starting to make that transition going from heating season to driving season. And there's usually a bit of bullishness that comes into the market at that time period in sort of mid-March into mid-April as we see how good demand is or how bad demand is for gasoline and what the setup is. So again, the setup for gasoline in terms of current inventories is not all that bullish. We seem to have adequate supplies. There's a couple of key refineries that are down on planned maintenance that we need to keep an eye on to make sure they come back on time and without any issue. So we'll see. Again, I think the market is too complacent. I think there's probably more risk on the macro level coming from both the ongoing issues in Ukraine, coming from supply side issues on the heavy side of crude, which can't seem to, every time we think we see some sort of solver, it doesn't come to pass, or OPEC doesn't want to increase production. So again, I think the market's maybe being a little bit too complacent here, and we should probably continue to find support along this weekly trend line here, at least for the next couple weeks, as we find out what really goes on as these tariffs go into effect. So I hope that helps. These are some of the things that I'm keeping a close eye on. Hopefully, you find this interesting. Again, I do think we're probably close to an inflection point. We need to find out what actually goes on with the tariffs and with some of these other balls that are sort of up in the air right now. But at any rate, thank you for tuning in. If you want more information, go to my website, theoilbalance.com. We'll soon be setting up a subscription service so you can get these packs, these chart packs, as they are produced. We can send those out to you. Have a good day. Talk to you later.